Well, welcome Maverick traders to another skill development course specific to the condor and the butterfly spreads. This is non-directional module 4. Joe with you here as always, trying to put these into Tradebench. Now guys, there's two things we're going to talk about today because the condor and the butterfly spread are very neat. They're cool. You can do a couple things with them. You can do the debit side, which is all calls or all puts, or you can do a credit side, which is two vertical spreads, two vertical credit spreads. So I'm going to show you both, and I'm actually going to show you both similarly to what we see the most often. So first off, guys, we're going to go to our trading center. We're going to go to the non-directional part. We're going to go ahead and click on module 4, condors and butterflies. Now we can pull the PDFs from there. However, out of the 4 PDFs we have, right? Because we have the iron condor and the condor, we have the iron butterfly and the butterfly. I chose 2 that we see the most often. The first is going to be the butterfly spread, meaning straight calls or straight puts. This is very common with traders. We see a lot of the butterfly spreads used for targeting, so slightly above the overall current stock price with a target, or below on the downside, so on and so forth, and all sorts of really cool trade management strategies below that. The other one that we do see a lot of is the iron condor. So I'm taking one of each. I'm taking the credit side of the condor and the debit side of the butterfly because these are the most common. I've got a couple examples we can run through when it comes to putting them to the trade bench. Understand, guys, you already know the strategies and the many different ways you can manage these positions. But I'm just going to follow along with what we have here on the sheets. So the first thing you need to do, if you haven't done it already, is go through and build the strategy. And I went ahead, as far as time goes, and built them. You can go down, you can see that I have a butterfly spread right here. It's the fifth one down, sorry. And we have the condor just below that. Once again, that is also a debit spread because it's just the condor. But if you look a little bit below that, I have the iron condor. The iron condor is indeed 2 credit spreads and an overall credit. I'm going to be using that as an example along with the butterfly spread just above it. So I have also built checklists for both of these based on each strategy's entry criteria. You can change these all you want, guys. One thing that I did like about with the iron condor with me personally is since it is a higher probability, lower reward, higher risk trade, that 20% there, credit must be greater than or equal to 20% of the total combo's max risk. That's a good one to adhere to. It's just nice because that way you're not too far off. And you'll see here when we run the numbers that it's kind of neat to know that, hey, I can actually lose more than I can make. But when you position size for max gain, max loss, it'll give you a lot more flexibility because down in the management area, you don't want to be reactive. You want to be able to follow your management all the way to the letter because these are very difficult to manage on the fly. All right, that's outside of the point. So let's jump into the trade bench and let's see what we have built. The first example I have here, I pull up my trader workstation, is the Russell. Now, most of the time, traders like to use this sideways strategy, especially the condor, on indices, ETFs, sectors, stuff like that. In this case, we have the Russell 2000. Very commonly used here. It's a range-bound strategy. So what I did is I went ahead and identified a range based on support and resistance and my outlook. And I came up with a trade. Now, this trade is going to be a 145, 150, 160, 165 iron condor. So let's go back to the chart just to briefly explain it. I see at 160 there's a resistance level. So I decided that's going to be my upper leg, and then I did $5 above that as far as security. Now the lower leg's a little bit different because as I built this trade, it started to fall, but I still believe in the pattern itself, which is 150 down to the 145 mark, and you guys can see that at 145 we definitely have support there. Now it looks a little ominous because it is moving lower. However, I still believe in the overall range. I see support here around the 150. So try to justify the trade for you guys. More importantly, putting it on is going to be better. So let's take a look at it. We're going to analyze this. I defaulted it to one contract. We got a $1.34 credit. I can put my cursor up and down. That means we got a 366 risk, right? So if I'm making a $1.34, I'm risking the difference of that and $5, which is $3.66. It's going to move as I talk. So keep that in mind. That means for each one full condor, one by one by one by one, it's going to be $367. Now, depending on what your overall risk reward is, you can add, 2 contracts, 3 contracts, so on and so forth. I'm going to stick with 1. The Condor does have the ability for you to take profits based on how it's performing over a certain amount of time. However, folks, if we just have 1 contract, we're kind of going to set it and forget it. Okay, so I'm going to put these numbers in. This is going to be easy to do because it's going to be net credit, net debit. So we'll come back to try to get these values a little bit later. So let's get to our trade. Now, guys, you could go through building an existing plan, going through the checklist, so on and so forth. You guys have seen me do that many times. I'm just going to go ahead and put in the nitty-grit, and we are going to put in this IWM trade. This is an IWN. I'm going to have to move this over so I can copy the prices. And by the way, folks, the expiration was the full expiration of July, so it's the full month. So I'm going to put 19 July 2019, right? Got to put that in there, make sure that, hey, I don't get those confused. Now, I like to start at the bottom and move higher. So 145/150/160/165 iron condor. Now, I put an iron condor because I know that the 145, 150s are puts, and the 160, 165 are calls. They're both credit spreads outside of it. I'm going to keep my multiplier as 100, making it a little easier. Put it on the Thinkorswim here. Now, folks, this is a credit, so guess what? We select short. I'm going to go ahead and make sure that we put it as not the condor here, but I'm going to go to the iron condor. This is definitely a 0. We are, let's see what here. We're probably seeing more of a consolidation. We could talk about, let's see what else we got here. Range bound, so on and so forth. And I'm going to go ahead and go to my FinViz because you can see this chart. And folks, like I say, it's unfortunate because it is falling off as I'm saying it, but I do believe in that 150 support. So I'm very confident in putting this in. So I'm going to go ahead and copy this. Control V, return, target, between support and resistance at expiration. Now, folks, I'm not a guy that likes to play one side or the other. A lot of my traders talk to me and says, well, we don't have to take the full loss on one side or the other. All you have to do is if it goes beyond your upper or lower leg, what you could do is you could just close that leg immediately for less of a loss and then hold the other leg to compensate for it. That's fine. But it takes a little bit of luck. It takes a little bit of on-the-fly reaction. And that doesn't work for me in my consistent trading plan. I'll leave the thing alone. I'll take a look at the thing when it's about to expire. Okay. A lot of traders will say, well, this thing's over a month. That's fine. When it comes to the week of expiration, I can take a look at it and take the whole thing off or take part of it off. In this situation, this is only one contract, so I'm just going to leave the whole thing alone. So, I can't hit submit yet. I have to go to the order quantity. So let's make sure I'm going to do one contract. The fill price is going to be $1.33, and there's our commission, so on and so forth. Our target price, now this is cool because we could do this because we're going to use the risk graph itself. Our target is 0.0, and the stop loss price is going to be $5. And all I did there, guys, is the same thing we've seen before. I took the spread minus credit, and that's going to be our max loss. So let's go ahead and hit submit, and we've got ourselves a trade. Now, these are actually easier to put on, especially if you do them as its own combo, all on, all off. They're very easy to manage. They're very easy to put on, and to tell you the truth, out of all the strategies we built in the Tradebench, they are the most consistent because the less you do with this, the more specific it's going to be and consistent when it comes to commissions and so on and so forth. So I just got to find this. Here's IWM, and we have it on here. So let's say you want to take it off, right? Very easy. Just add the exit order. You can put in the fill price. Now, guys, when it comes to the fill price, you take into consideration that you have a $1.33 credit, the credit that we have, minus whatever we had to pay to get out of it. Okay. So if the credit increases, meaning let's say that we made money on the one side, we got the full $5 spread, but let's say that we had to close it. Let's do this. Let's say that the stock closed at 162.5. That means we had to spend $2.50 to get out of the one leg. So we're going to have to reflect that against the $1.33, I believe. Let's go back. I want to make sure I got the numbers right for you, so when you go to review this class, I'm not totally crazy. Yep, 133 on the average. So at exit order, I had to spend $2.50 to get out of it, minus the $1.33 credit equals 117. So order 1, because that's one contract, fill price 1.17. Which shows we still get a gain. We're just not going to get the full $1.33. We're only actually going to get, what is that, about 12 cents, 13 cents? Well, let's do it right. 16 cents. All right. Okay, so we're out. And it's pretty easy to read. Net profit of $2.10, multiplier times 100 commissions, $13. We basically broke even on this, and the reason being is because it went above one of our strike prices. Now, you can do... it just depends on where you get filled. In this case, I said it closed at 162.5, which is halfway through the upper spread minus what we paid for it. Let's say it closed right in between. It would be 0.00, right? That's a 100% gain, so on and so forth. If it went to the downside, 147.5, it would be that same $2.50 minus our 133 credit, and it'd still be, in this case, the exact 117, just to the other side. So very simple if you put it all in and all out. Okay, so that is our iron condor. Let's jump over to, that's the iron condor, so let's jump over to the butterfly spread. Now I have another example for the butterfly spread, very similar. I was actually somewhat thinking of just immediately using the same chart, but I figured that might be a little bit too confusing. So I went ahead and found, the financial sector. Let's get to the chart first before I walk you through this. The financial sector is a little tighter, a little more symmetrical triangle. It's also shorter term. I went ahead and put on the week 1s instead of the week 3s because, hey, I'm being tighter with my target. I'm actually shooting right around that 27 mark. So I'm going to go a little bit less in time. So I did the 26, which is right here. See support. 27, where it's pretty much right at. Right? And then the 28, which is just below this resistance. So I figured, hey, 27, 28, 26, butterfly spread in the next week and a half. Pretty short term, pretty tight, nice in and out. So let's analyze this thing. I like to see these over 2 to 1. That's my rules, and I don't have that here. I'm risking 45 cents to make 52 cents. I'd rather have that 45 cents to make 90 because I'm a 2 to 1 guy. But that's not important. What's important is how to put this into the Tradebench, which is very easy. This is a net debit. It's 45 cents. So let's go to our Tradebench. And I'll move this over so I can copy it in. And let's go to our trade. I'm going to go without a plan. Once again, I can build this as a plan, go through the checklists. This is going to be our XLF. The date is 5 July 2019. 26, 27, 28. Call butterfly spread, because I'm going to use calls. Oh, nope, apologize. Put butterfly spread. I'll tell you why. Okay, so we got this going. Now that I've brought that up, let me show you real quick. This is a side note. You guys are welcome. The reason why I did the put butterfly spread is because $27. The stock is currently at $27.18. So the $27 put is slightly out of the money. Now, I do this because I would rather avoid early exercism, having to worry about something that's in the money. Now this could easily be $26.50 tomorrow. It doesn't matter. I just like to start them off to where the sold strike is out of the money, it really is preference. It does 100% proven does reduce the being called or put to if it's out of the money to start with, especially with something that's only about a week and a half out. If you were to do the exact same strikes, 27, 20, 26, 27, and 28, and go to the call side, the risk reward would be identical. Because what you're paying, if you pay a little bit more for the outside legs, you're going to get more for the inside, or vice versa. It doesn't matter. So the risk reward's the same. There's no advantage or disadvantage. The only thing that I like, and this is my personal note, is I like to do it out of the money. That way, it just lowers the probability of being exercised. That's it, plain and simple. That being said, let's get back to the spread. So I did the 26, 27, 28 put butterfly spread. Once again, doesn't make a difference. My multiplier is definitely going to be times 100. Now this bad boy is only, let's pull it up one more time, 45 cents. So I'm going to move this over here. And we can do, let's do it by 500. So 500 point divided by 45. We can do like, oh geez, how many is that? 10 contracts? So let's do 10 contracts, because this gives us the ability to make adjustments based on whatever your rules may be. Now guys, remember, you can target this, so you could put them in and out of the money with the butterflies. You can, after the first week, or at the week of expiration, or 3 days before, if it's close to your target, you can take half profits. There's all sorts of cool things you can do when you've got more than just one leg. And what I mean by one leg, that'd be a 1 by 2 by 1. That's 1. So I can do 10 of these. So we'll do that. This is a butterfly spread. I'll put this in first before we go fill out our filters. We're going to do 10 of them. And we're going to say we got that for the 45 cents that we wanted. And you can see our total risk is 456 bucks. Target price is going to be the difference of the two, or the high point. Since they're $1, target price is going to be $1. And our stop loss is 0.01. So you can put in the target with these, because it's net gain. It's 100% loss or 100% gain. That's what's cool about that. Obviously, 0 on the label. We are going to have the chart pattern on this. It's going to be consolidating again, maybe a symmetrical triangle pattern to a break. Looks like up. I know that we did the puts, but it does look up. It's above its averages. Whatever you want to put in there. Let's go ahead and pull up a chart on it just for fun. All right, we'll go ahead and right-click, copy. Let's go back to the Tradebench, Control-V, turn. That's nice. How about this? Looking to take, oops, let's go back to where I can read it here. How about this? Half profits in a week. Cool, right? Or half position in a week. Yeah, depending on where it is. Anything you want to put in there. So I'll hit submit, and the trade's active and live. So let's say that we do take half. Let's say we take half off after a week, and we've gotten ourselves like it's worth 60 cents, right? So it's worth 60 cents a week before it expires. That's pretty easy to do. If I can go ahead and find it, there it is, XLF. I'm going to go add exit order. All right, let's take it off, and you know what? Let me give you a little bit more of a visual, just in case I'm losing some of you, which I shouldn't. You guys are probably experts at this. All we have to do is go volatility step. Let's go day step, 4 days. Let's knock this back a couple of days because there's not that many in there. There we go. So let's say that we hit this curve right here on the, no, let's go down. Let's go to the 30th of June, right? The week before, the week of, I should say. And we're right at that area. That profit gives us 13 cents per share, per contract. So that's going to be, and what I got there, folks, is I'm looking down in here again. I got about $13.80, which would be about 13 cents added to our 45-cent original credit or debit is 58 cents. Just makes it a little bit more realistic. So I'm going to say, here we are, order quantity. I'm going to take half, 5 contracts. Fill price was 58 cents. Sweet, right? Taking half profits on 6 30/19 week of expiration. There you go. Boom. And then we can just follow it along and do whatever you guys want to. It's easier to play with the net debits versus the credits sometimes, but let's go over here and you can take a look at what we're doing so far on this. There it is. We got 5 left. We've already booked some profits on there. And then when you guys are ready to get rid of the rest of the order, it's pretty easy to hit the add exit order and continue from there. All right, folks. Good luck with everything. And if you've got any questions with the Tradebench software, reach out to your coach as you're working with them. They're all going to figure it out. On top of which, I have to remind you one more time, there are multiple ways to do this. You can do it any way you want and understand which works the best for you, because if you get the all-time cost in and the all-time cost out, that's all we care about. How you manage it, how you move it, how you log it. You guys can see that I actually put the strikes. I put the whole trade in the tag lane. I find this easy because when you go to do, let's just go ahead and do this. When you go to, now these are my open trades, and I can easily see what they are. That's what's so cool about that. But let me go to my reports here. Well, no. I want to see, how about my closed trades? So you can see the closed trades. It's actually easy too, because I put the ticker symbol, but then you got dash dash, and I can tell what it was. I think there might be 1 or 2 in here that I've done twice. Yeah, there are. So here's take 2 and take 2. Right here, but guess what? I don't know which is which. I know the dates are different, but I don't know what's what. But take a look at my CMG trades just above it. Okay, this is my 67,700 vertical spread, but this is my April 68,710, 740, 1 by 2 by 1 butterfly spread. So it's much easier to be detailed in this point in the long run. But once again, there's no wrong way to do it. Do it your best way. Always reach out. Be working with your coach to figure out what that is. Thanks again for joining me, folks, and we'll see you next time. Bye-bye, everyone.